Welcome and congratulations on entering the inner circle of senior living. The Inner Circle discusses relevant topics in senior living investment, operations, financing, and beyond to drive the industry to the next level. With a continually changing environment, let's start the collaboration now.
What's up, guys? Welcome to the Inner Circle of Senior Living. I am your host, Scott McCorvie, and I am so excited about this episode. I started jotting down some notes and creating an outline, and there's so much good information about this topic. So today we're going to talk about senior living investment structures. So whether you're an owner, operator, broker, lender, investor, anyone, you're going to want to understand these different structures and different concepts that I'm going to talk about today. Even if you have one structure now, when you go to sell your property, there could be an investment that's looking in a totally different lens. So it's really good to understand these different concepts for senior living investment. I'm going to be talking about the RIDEA. I'm going to be talking about the lease, triple net lease, and also the joint venture. And I want to be on the same page when I go over this terminology. I'm going to talk about the owner, the tenant, and the manager as three separate entities. The owner, also called the PropCo, is the actual ownership entity of the real estate. Typically, I would say 99.9% of the time, it's set up in an LLC, and it's the one that actually owns the real estate itself. Now, this owner is going to have a lease with the tenant entity, also called the OpCo. And this is traditionally also the manager, so the operator manager. However, this tenant entity is going to have a management agreement with the management entity. So that's the third terminology. So I'm going to be talking about owner, tenant, and manager. The owner owns the real estate. They have a lease in place with the tenant. So the PropCo has a lease with the OpCo, and then the OpCo has a management agreement with the manager. So I want us to be all on the same page there. The first structure I'm going to talk about is the RIDEA. This one is, I know there's a lot of interest. I know there's also probably a lot of confusion. I actually wrote a blog post probably 5 years ago. If you go to your computer right now and Google RIDEA, so that's RIDEA, it's the first article that'll pop up. And I wrote this 5 years ago. It still gets a couple hundred hits per month. So I know there's still a lot of interest. Anytime I know there's a big announcement about a RIDEA investment or acquisition, it gets even more hits. So we'll talk about a little bit about this structure, some of the advantages and risks to think about with this structure. Now, when I talk about RIDEA, this is specifically just for REITs. There's a very similar concept for private equity or just sole proprietorship, whatever, where you have an OpCo, PropCo, but RIDEA itself is just for REITs. So RIDEA stands for the REIT Investment Diversification and Empowerment Act of 2007. Prior to 2007, healthcare REITs had one structure. They could just do triple net leases, basically, a sale leaseback. They would sit back and collect their rent payments with their annual escalations, but that was it. So the RIDEA Act opened the door basically for healthcare REITs. So instead of just triple net leases, the RIDEA allows the REIT to actually participate in the net operating income of the operations of the community. So the net operating income, or the EBITDA, actually goes back to the REIT instead of just a standard, typical triple net lease rent payment. So that was the biggest thing, and this was very important for a number of reasons. One, it allowed REITs to participate more in value add or reposition assets. So if a REIT has a lot of big ideas for a property, they're putting a lot of capital into it, it's really hard to calculate what that appropriate rent payment's going to be 4, 5, 6 years down the road, right? So with the RIDEA, it allowed them to put all this investment, do all this repositioning, and not have to worry about what that rent payment is down the road, because they're actually collecting the net operating income. Now, one thing I want to point out is with the RIDEA, there has to be a third-party manager in place. So the government did not want REITs making day-to-day healthcare decisions. So they said, okay, you can participate in the operating income, but there has to be a dedicated third-party manager that's not owned by the REIT. A REIT can't own more than 35% of the manager. And the managers are the ones that are making the day-to-day care decisions. However, the REIT does collect the actual net operating income from the property. Structurally, and I'm not an attorney definitely attorney will do this for you. Structurally, there's what's called a TRS, a taxable REIT subsidiary. So structurally, there's going to be an owner and a tenant entity with a lease in place. However, both of those entities are actually owned by the REIT. So they just roll up to the REIT. But there has to be a lease in place with a rent payment because any cash flow on top of that rent payment is taxable. So that's why there's a TRS that's created with a lease in place. However, it all ends up rolling up to the REIT itself. Now, the biggest advantage is the REIT does participate in the net operating income, or EBITDA, so they can make a lot of different investments than they would typically make. Also opens up the door for development because, again, you don't have to try to calculate what the stabilized rent payment is going to be. You participate in whatever that stabilized income is. So it opened up a door in the horizon for a lot of different new investment options for the REITs. Private equity always had this, so it's a similar structure for private equity. However, there's an opco, propco. There is a lease in place. There's a manager. However, with private equity or any other structure or ownership entity, you can actually own the manager too. So private equity can have ownership interests in the manager, whereas a REIT, they can't own the third-party manager. It's good for a few different senior living asset classes. One being extremely stable infill locations where there's not a lot of variability, because with the upside is that you collect the net operating income from the actual performance of the property. That's also a downside too. So if the property performance was a decrease, then you would collect a lower net operating income. So there is more of a higher risk. We talk about high risk, high reward. You collect more income from the RIDEA structure. However, there's a risk of decreased income. It's not guaranteed payments that you'll receive in a rent from a triple net lease structure. In the RIDEA, you can get higher income, but you also can get lower income. Now, to mitigate that, REITs have a very strong asset management program. So they're constantly working with the manager, working with the operators, understanding the market conditions. And really, the big thing too is investing a lot of CapEx dollars into these properties. There is, risk of new supply, new development, lower prices, reputation issues. A lot of that goes into each property decision. So the REITs really are actively managing these properties with the operators, as well as putting a lot of CapEx dollars in there to maintain that competitive advantage. It's also good for assets that you are looking to reposition, any kind of value add asset. So if there's a property that you want to convert some units, if you want to put some CapEx dollars into a total renovation, if you want to add an expansion, all of those are good candidates for the RIDEA as well, because you don't have to try to calculate what that future rent payment is. The income is what it is, and you receive that. There is some risks. As I mentioned, there could be decreased performance. Now, with the management agreement structure, we can put in some credit enhancements that can mitigate some of those risks. However, for the purposes of this, we'll just say there's definitely a risk of decrease. There's also higher costs, as I mentioned, more asset management, more hands-on approach than just a triple net lease. You're actively managing that asset with the operator. There's also higher CapEx. Like I said, you need to really invest in this property to maintain that competitive advantage so that NOI does not go down when a new property opens up down the road. Another advantage of this is a hedge against inflation, and I'll describe that. When a traditional triple net lease, you have annual escalations. Those escalations could be fixed or they could be tied to a CPI. But with the RIDEA structure, it's really tied with inflation as it is. So if there's periods of high inflation, you're not going to be raising your rents 2 to 3%. You're going to be raising them 5, 6, 7% per year. Those expenses are also going to increase, your food costs and whatnot, staffing. Those are going to go up higher with inflation, which will trickle down to your NOI. Instead of a 2 to 3% increase, you're going to see 5, 6, 7% increases in times of high inflation. So instead of trying to calculate, 2 to 3% per year, where inflation might be 5, 6, 7%, then that time value money, you're losing actual dollars with those future increases in times of high inflation. So it is a hedge against inflation too. One thing that REITs think about. Now, I will mention that the RIDEA structure is only for independent assisted living and memory care. It is not utilized in skilled nursing or post-acute because those property types have a much higher liability associated with them. Now, there is a debate about how much liability a REIT has because they're actually participating in the operating income instead of just an ownership in a lease structure. So there is potential of higher liability, and that's one reason that this RIDEA structure is not used in skilled nursing or post-acute, because there's higher liability in those property types. It's used in independent assisted, sometimes memory care, because of the lower acuity nature of those property and the lower liability of those property types. So that's basically it for the RIDEA. I mean, there's a lot of different things to talk about, but that gives kind of a high level summary of that structure. It's used a lot. It's used a lot by REITs for the reasons that I mentioned. It hasn't been used as much lately, and the REITs classify it different ways. Some call it the SHOP or senior housing operating portfolio, but they're all the same concept, that it's not just triple net leases. They're actually participating in the operating income. There's been a pullback in this RIDEA structure in the last few years because of all the new development concerns. There's a lot of concerns of, new supply entering the market might affect the operating performance, which would impact the net operating income that's received by the REIT. So that's one reason that a lot of REITs have pulled away from this structure as of recent. They still have a lot of it in there, but they pulled away. The REITs a lot of times, when they have this operating structure, it's not a one-off deal. They usually have a portfolio with a large operator. So that's one thing to think about as well. The next structure I'll talk about is the lease. It's usually in a triple net lease fashion. So triple net means rent net of real estate taxes, insurance, and expenses. So this is basically a guaranteed rent payment regardless of whatever the operating expenses are. So real estate taxes go up, that's on the tenant. The tenant is still paying the same monthly rent to the owner, regardless of operating performance, regardless of any of the other variables. It's net of everything. They're just paying a rent. Now this rent is calculated with what's called a rent coverage. A rent coverage is the NOI, or the operating income, divided by the rent payment. And the owner wants to have a little bit of cushion there, and the tenant too wants to have a little cushion from the operating income, so they make sure that they can pay their rent expenses each month. So that coverage depends on the acuity, the age, the quality, the operator, cross-collateralization. There's so many variables, but typically that coverage is a 1.2 to 2.0 times coverage. And when that gets down to 1.0 is when there's concern, because that's meaning that the operating income is just barely covering the rent. Now, there's ways to mitigate this some. There's typically the tenant's putting up a deposit. So that could be up to, years of rent that the tenant puts up in case of, performance issues or whatnot. There's also typically guarantees, either personal and or corporate guarantees to pay the rent. And a lot of times the properties are cross-collateralized. So that lowers the overall risk profile for the owner, because if one property's performance was to decrease, you still have other properties that can make up the difference. So when there's just one rent payment for 10 different communities cross-collateralized together, if one or two of them were to have a bad month, the other 8 or 9 can pick up the slack. So a lot of times these rents or these leases are cross-collateralized, and that lowers the risk profile for performance going down at one of the properties. So there's advantages. Obviously, the owner has a lower risk profile because they're not engaged in the operations. They usually have a guarantee. A lot of times these are cross-collateralized, and they can count on a guaranteed income stream for however many years with the annual escalation. So there's more of a guaranteed income. There's advantages for the tenant in that they have incentive to increase performance because they have a guaranteed rent payment. However, if their NOI goes up, they keep that extra cash. So we call that leakage, or you can call that coverage. That additional cash flow from NOI to the rent payment goes to the tenant. So there's incentive to really increase performance. Also, the tenant has a longer term. So when a lease is put in place, that lease stays with the property regardless of who owns it or where it's sold. Okay, so a lease term is typically between 10 and 30 years. That lease stays in place regardless of when the property is sold. So there's a lot more longevity, a lot more stability for the tenant operator with a lease structure versus a management agreement. And we can talk about this in another episode, but there's usually a lot of termination clauses in a management agreement that does not have the guaranteed longevity that's associated with a lease. The downside, I guess, is that a REIT, they get lower cash flow because there is that coverage, that leakage between NOI and the rent payment. And the downside, I guess, for the tenant is that they're much more liable. A management agreement, can be terminated, whatnot, but when you have guaranteed for 20 years down the road, they have much more liability. So that's the lease structure. The third one we'll talk about is the ever popular and very complicated joint venture, or JV. Now I'll do a future episode dissecting this and talking about this so many ways, because there's crazy different ways that you can create a joint venture. But right now I'll just go over some high level different inputs to a joint venture. A joint venture is 2 or more equity owners in the real estate itself. The typical splits are 80-20, 90-10, sometimes 95-5. And what that does is that creates a limited partner, or LP, which is the majority owner, or also called passive investor, along with the general partner, or GP. That's the minority owner, the active, usually operator manager, that's more active in the day-to-day care or investing in the property. So there's lots of advantages and disadvantages of a joint venture. One of the biggest advantages is with the joint venture, there is a waterfall of distributions. So this waterfall is calculated from just typical operating cash flow, as well as major refinance and or sales proceeds. So we'll talk about basically both of those together. The one thing that the biggest advantage with the LP or the minority owner is they usually have first position in cash flow. So even though they're not active, they're putting in the larger percentage, they want to be protected in case of the downside. So they usually get first dibs on cash flow. And the way it's set up is several different hurdles. In each hurdle, the cash flows get distributed at different amounts. And that's the biggest advantage for the LP or the minority owner, is they get what's called a promote. And a promote is unequal cash flow distributions based on increased performance. So as the performance goes up, certain hurdles are met. Once each hurdle is met, then there's usually more of a disproportionate cash flow that goes to the LP and the GP. So let's say it's an 80-20 JV. Well, all cash flow up to, let's say, an 8% cash on cash return will go to the GP in this hypothetical scenario. Well, after several hurdles, even though the LP only put in 20% equity, they might be receiving 50% of the cash flow. So there's a lot of upside for the LP to increase performance, to increase value, because they get a promote, an unequal cash flow distribution down the road. So even though they're in a lesser position as far as initial cash flow, they have a much higher position for value creation or increased cash flow. So those are the couple of reasons why it's popular for both the LP and the GP. A couple things to think about with the joint venture is there's much more intense negotiations and much higher legal fees. So there's a lot more documents that need to be negotiated and signed before you enter in a joint venture. And that's really important because you really need to be on the same page for all these major decisions that might happen down the road before you enter this partnership. Some of those major decisions are who's going to manage the property, If you have two investors, they need to come to terms on who's doing the day-to-day management. Also, what about refinancing down the road? You need to come to terms on how that's calculated and where those proceeds go. Major CapEx decisions, renovations, expansions, all those things. There's not just one owner that's making all the decisions. You got a partnership now. So you've got to come together, come to terms. It's definitely more complicated. But on the flip side, a lot of groups like it because it creates alignment. So instead of just collecting a management fee, 5%, 6%, whatever the management fee is, you've got an active investor side by side with you that's your operator manager, but they're also your partner. So there's a lot of alignment there that they're not just collecting their management fee, they're participating in that cash flow distribution, they're participating in that value creation. So a lot of LPs or private equity groups, they like this because it creates that alignment and, it has a partner that's invested in the property. That's primarily it for the joint ventures. I can talk forever about any one of these structures. Feel free to email me if you do have any questions or concerns. My email is scott@srgrowth.com. Email me with any of your questions or concerns about these structures, or if you just want to shout out and say hi, or if you have a show idea or an interview idea, would love to hear from you. Also, hit up our social media. We're on the Instagram. We're on the Twitter. We've got a great LinkedIn group. You're going to want to join all of those to be up to date on all the news and also a lot of cool discussion questions that are going out there. Feel free to search the Inner Circle of Senior Living on all social platforms, or you can just go to the website. If you go to srgrowth.com, there's a menu choice on the top that says Inner Circle. Click on that, and that'll have a link to all of our groups. But you're going to want to get involved because we've got exciting things planned for the future. Please review this. Share this with your colleagues. The more the merrier. So we want to get the word out, get as many people as possible involved in the Inner Circle. Subscribe on whatever platform you're on. If it's iTunes or whatever your podcast platform is, subscribe to that so you make sure you'll get the up-to-date shows whenever they're released. Reach out to me. I'd love to chat with you. Look forward to meeting with you. But for now, let's go out there and make a difference.
We appreciate you participating in the Inner Circle of Senior Living. Now, it's your turn to help spread the message. Be sure to share your questions and comments with the Inner Circle community and discuss the different topics with your friends and colleagues. Until next time, thanks for joining the Inner Circle of Senior Living.